Hi, I'm David Buckland and welcome to this week's Video Insight. As can be seen from the graph on the screen, US 10-year bond yields have, over the past 4 decades, rallied from 16% to trough at 0.5% in mid-2020 before backing up to 4% over the past 2 years. The rally famously started when the US Federal Reserve Governor Paul Volcker set out to break the back of inflation, which had been building up in the 1970s with oil shocks and dramatic increases in wages. While this led to a severe recession in the early 1980s, it also led to a great buying opportunity. It is little wonder that most asset classes have performed superbly, with bond market tailwinds largely assisted by central banks' quantitative easing and persistent low inflation over the 2000s and 2010s decades. On the other side of the coin, the jump in bond yields, particularly more recently, has unsurprisingly seen the prices of many asset classes struggling. With inflation rearing its ugly head and hitting the highest level for 4 decades in many Western world economies, it is important to assess how we avoid losing real purchasing power. And what can we do to drive real inflation-adjusted returns from our investments? To illustrate, inflation since 1980 has averaged nearly 4% per annum, meaning any asset or investment which has not gone up 5-fold since 1980 has gone backwards in real terms. A 2% inflation rate per annum, for example, would have required an uplift of only 2.3-fold, not 5-fold since 1980, to avoid going backwards in real terms. The point here is inflation destroys value, and higher inflation requires a higher nominal return to avoid the loss of purchasing power. This is a particular issue for retirees who may have to fund their livelihood for 20, 25 or even 30 years. And the longer we need the money to last, the more it is likely to be eaten away by inflation. To protect yourself from loss of purchasing power, it is important to invest in a solid portion of your portfolio in growth assets. Whilst Australian property has done remarkably well over recent decades, a portfolio of good quality companies can generally offer a good hedge against inflation over the longer term. I say longer term because even the best companies can suffer during severe recessions. However, experience tells me it is during recessions, during periods of maximum pessimism, when the opportunities become most plentiful. That's all I have time for this week. In the meantime, please follow us on Facebook and Twitter.